Hello and welcome everyone to this week's weekly market recap for the week ending Friday, August 22nd, 2025. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats. It's a pleasure to be with all of you again this weekend. Interesting end of the week. Finally, one of the things I was looking for was for the Fed at the Jackson Hole speech. I was looking for Fed Chief Powell to mention something about rate cuts, and he did do exactly that. We did get a mention of rate cuts, and almost immediately started to see some of those interest rate sensitive areas of the market really explode to the upside. We saw small caps have a huge day on Friday, along with the regional banks. We had home construction stocks do extremely well, transports bounce back. Some of those areas that we were really looking for some leadership with the mention of rate cuts. That's exactly what we got. That's where the leadership came from at the end of the week. So it turned out to be a pretty good week after kind of stumbling along through the first few days. But that big rally on Friday certainly helped all of our major indices, but especially the small cap index. So let's take a look at what happened last week. We did have the IWM lead the major indices. So IWM gaining more than 3%, close to 3.4%. Transports up 2.8%. S&P 500 2.63%. Actually, S&P 400 mid cap 2.6%. Dow Jones 1.5%. S&P 500 gained 0.25%, and the Nasdaq 100, even with the gains on Friday, still dropped almost 1%. So there certainly was a little bit of a rotation away from growth stocks into some of the more value-oriented areas of the market. Some of the dividend payers did better. Of course, with falling interest rates, their dividends look better. So a lot of income investors moving into some of those names. But small caps really were on center stage on Friday with the mention of the potential rate cut at the next Fed meeting. So anyhow, that's how the indices did. If we take a look at the sectors, energy leading last week, gaining 3%, real estate 2.44%, materials 2.39%, financials 2.12%, and then industrials, kind of what I was talking about, the more value-oriented areas. Consumer discretionary also got a big lift because of areas like home construction that did really well. I think the home construction group, we'll take a look at that chart a little bit later in the show. But home construction gaining, I think, 5% on Friday alone. So it was a really big day. And then if you're wondering about the growth areas, well, there's technology and communication services down the bottom. These were the only two sectors that underperformed the S&P 500. So it was a lot of those growth stocks that just did not perform particularly well. They came back on Friday, but they had a rough week heading into that day. And as a result, net for the week still finished down. S&P 500, you can see that bounce off the 20-day moving average, moving back up, not quite getting into record high territory, but right on the verge again, finishing at 64.66 and change, almost 64.67. Another look at the S&P 500 here is also supported. I wanted to show you a little bit of what's going on with the growth, because here you can see the QQQ relative to the spider getting hit these last couple of weeks. We did see discretionary outperforming staples, which I like to see. But look down here. This is large cap growth versus large cap value. This is a little slightly different look at large cap growth versus large cap value. Then we got mid cap growth versus mid cap value, and finally small cap growth versus small cap value. And you can see everything starting to roll over here in August, either since the beginning of the month or a little bit later, maybe towards the middle part of the month. But growth definitely beginning to lag. And it's interesting because this is something that I talk about and I've taught in the past, that once you get past August or you start to get toward the end of August, money does historically rotate away from growth and more into value. And I think this seasonality chart will kind of paint the picture. Hopefully you can see this visually. So what I've done is I've gone back over the last 13 years, all the way back to 2013. That was the year that the S&P 500 finally cleared the highs from 2000 and again in 2007. So in my opinion, that's when we had the confirmation of the new secular bull market in 2013. So since we've gotten that breakout on the S&P, since we've gotten that confirmation of the secular bull market, I want you to look at the areas of the market, well, the growth area of the market, and how it has performed during the months of May, June, July, and August. Now, as you're looking at this, I want you to think back to all the headlines that you've seen over the last 12 or 13 years about go away in May. Remember, that's kind of like a theme. That's what the media likes to talk about. And I keep saying, no, don't listen to them. You do not want to go away in May. You want to, if you're going to go away sometime, it's probably more like mid-July. And certainly by the time you get into late August. I mean, historically, late August and throughout the month of September is when we've had our weakest period. And that dates back all the way to 1950. But take a look at growth versus value during the months of May, June, July, and August. So again, this is a seasonality chart of the IWF, which is large cap growth. That's the iShares large cap growth, compared to the IWD, which is the iShares Russell 2000, or excuse me, Russell 1000 large cap value. So large cap growth versus large cap value. And you can see that growth averages outperforming value during the months of May, June, July, and August. And every one of those months, the average outperformance by growth is more than 1%. And this is an average over the last 13 years. So May averages outperforming, growth stocks average outperforming by 1.5%, June 1.5%, July 1.2%, August 1.2%. The interesting part about this is that if you look at the other 8 months, none of them are over 1%. In fact, the only one that's even close is January at 0.7%. February, March, April, 0.1, 0.2, 0.3. You get past August and you've got September minus 0.6, October 0.1, November 0.0, and December minus 0.2. So May through August is the sweet spot for growth stocks. And so you have to understand, historically, growth stocks, I mean, we're getting ready to head into September. We got one more week, and then we're going to be in September. Understand that we don't normally see that same level of outperformance by growth stocks as we now move toward the end of the year. Even though the fourth quarter tends to be our strongest quarter of the year, it's not so much driven by growth stocks as it is essentially by all stocks. Look at October. It's relatively flat, growth versus value. November is flat. November is a great month for stocks, but growth versus value is flat over the last 13 years. And December, you can see growth actually slightly underperforming. So even though the fourth quarter is the best quarter of the year, it's not typically driven by a lot of outperformance in growth stocks. I just think it's important that everybody understands that. So when the Fed started talking about a rate cut, potential rate cut on Friday from Jackson Hole, that to me was a sign that money was going to rotate into more value-oriented areas, and especially into small caps. That's what I was looking for, and small caps absolutely exploded. I'll show you the chart from Friday in just a minute. But here's the Nasdaq 100. So the Nasdaq 100, we did move back up and get through the 20-day moving average and back up above 23,500, or right about at that level. But we're still kind of in a range. This is not where we're seeing leadership. We did not get leadership. Again, if we go back and we look at that, the major indices, the Nasdaq 100 actually finished down because technology had a rough week. So I don't know that we want to look for the Nasdaq 100. I think we've got NVIDIA coming up with an earnings report this week. I think that's going to be big. And I do think that they're going to have a good report. It's going to be interesting to see whether or not they break out again. So I think the reaction is going to be important there. Looking at the IWM, so this is the Russell 2000. Look at that move on Friday. Very, very, very strong action. I want to show you on an intraday chart what happened at 10 o'clock. This is when the speech started, at 10 a.m. on Friday. So we had already gapped up and we were starting to move back up, but literally the IWM in 10 minutes ran from 227 and change to above 232. And over the course of the next hour, moved up over 235. Now, remember, this is the same IWM that I talked about when it broke above 210 and then pulled back to hit the 20-day moving average one more time. I talked about it then that this pattern measured up to about 249. Folks, we're at 235 from down in the 207 area. We've made most of that move now to the upside. We still have more to go. And that's just the initial target. I've talked about this being an area where I think we could see significant outperformance in the second half of 2025 and into 2026. And I still fully believe that. And I think Friday was just a glimpse as to how quickly small caps can move once we start to see rate cuts and the talk of rate cuts. So some of the other areas that I talked about, look at the transports. Transports bouncing off the 50-day, making a move to a new high. That was a nice move back up above the 16,000 level. And then we had regional banks. This is an area that absolutely will benefit from lower rates because lower rates, keep in mind that the smaller banks borrow from the Federal Reserve and from other banks using the Fed funds rate. And that's the rate that gets lowered by the Fed. So all of a sudden, small and regional banks are going to get much better access to capital and much cheaper access to capital, which I think is going to drive prices higher there. And that also will make it much easier for smaller and mid-sized companies to get capital, to be able to borrow and to borrow cheaper. And all of a sudden, they can compete, or at least they can compete better against the larger firms because their access to capital goes up and their borrowing costs go down. So it's really a positive thing, not just for the small and regional banks, but for their small and mid-sized clients as well. All right, home construction. Check out home construction breaking out again. So anytime, we start talking about rate cuts, number one, it's the Fed funds rate is not directly tied to mortgage rates. However, when the Fed starts talking about rates coming down, it's telling us that they're no longer as worried about inflation as they are about the economy. And so what that does is that encourages folks to buy bonds, longer term bonds, 10-year bonds and so forth, because there's no inflation expectation any longer. So you're not wanting higher yields. You're not going to sell the bonds because of inflation worries. Instead, as inflation worries come down, you're going to buy bonds. And when you buy bonds, bond prices go up and yields come down. And when those yields come down, the 10-year Treasury yield is much, much more directly tied to the mortgage market and the mortgage rates. So that's where I think we're going to see a dip in mortgage rates coming up, which will certainly help the home building group as well. All right. For those of you who are maybe new to EarningsBeats, if you go over to our website at EarningsBeats.com, you can scroll down, sign up for an EarningsBeats Digest. It's our free newsletter, name, email address. We do send out a newsletter Monday and Wednesday morning. And so we'll be sending that out this week. So you want to make sure you're signed up with name and email address to check that out. And I'm going to try to have a surprise in Wednesday's EB Digest as well. Might be in Mondays, but definitely it'll be in Wednesdays. So make sure that you subscribe if you haven't already. Going to send you a chart list I think you'll enjoy. So keep that in mind. Make sure you sign up for that. If you want to try our service, you can sign up using this green button, start your no-cost trial. You do need to have a credit card to sign up for our paid service, but you won't be charged for another 30 days until after your 30 days is up. Also, one thing I wanted to mention is if you look at, if you go to EarningsBeats and you scroll down, we do have our historical performance of our portfolios. We just started a new quarter starting on August 19th that runs to November 19th. Already our portfolios are taking a big jump versus the S&P 500. The aggressive portfolio in particular, I focused this quarter on small and mid-sized companies that I think are going to outperform. And look at the jump we had last week, 4.08% in the aggressive portfolio, or that's what we're up since August 19th. The S&P is not even up 1%. So already 4 times the performance on this aggressive portfolio just getting started this month. So please make sure if you do sign up for the 30-day trial, you can come in and check out all of our stocks that we have in our portfolios. I think it could make a big difference in how you perform over the next 90 days. So be sure to check that out. All right, a couple of other things to talk about. I wanted to point out a couple of the small cap stocks. We gave a list of small cap stocks to our members back in June. It was top 25 small cap stocks, and we numbered in order the top 10. 2 of the 10 stocks that were on our top 10 list, I wanted to just feature and show you right now. One is NXT, Next Tracker, made a breakout on Friday with that small cap action, the bullish action we saw there. You can see Next Tracker had a big move. Also, Magnite. Wanted to pull up Magnite and show you Magnite moving up off of a 50-day and a price support test from back on Wednesday. The stock got as low as 21, came back up, closed over 24 on Friday, and on the verge of another breakout, close over 25 would be very bullish for Magnite. Finally, let's go through. I wanted to show you the Mag 7. We're going to wrap up with the Mag 7 because this is the larger, more growth-oriented stocks. I think these companies will do okay. I'm not sure that they're going to lead. NVIDIA will be interesting because they report on Wednesday at the close, after the close. But the others, I'm not so sure. Apple finally starting to strengthen a little bit. So I like this, the fact that we've moved back up, volume picked up. Watch that rising 20-day moving average. If we're trending higher, we should hold there. Microsoft, after gapping up with earnings back at the end of July, it's been straight down. I like the action on Friday, though, and I think this could be the reversal on a 50-day moving average test. So let's see if Microsoft can start to regain some strength, maybe consolidate a little bit here between the moving averages, and then let's see if we can get back through about 515 or 520. Next up, NVIDIA. NVIDIA AD line looks great. Relative strength has been climbing for the last several months versus its semiconductor peers. I think NVIDIA is going to do really well. I think their earnings report is going to be strong. But what kind of reaction do we get? Do we get that breakout above these recent highs around 183, 184? If so, then I think maybe we run a little bit with NVIDIA. Amazon coming off the 50-day test, moving back up, got a little bit of overhead resistance from about 233 to 236. So we need to see if we can get through that level. Next up, Tesla. Tesla had a big day on Friday as well. Nice jump from 320 to 340. But I just see, if I annotate this for you, what I'm seeing is just a squeezing triangle. So you can kind of see the tops right there. And then coming down here, got the bottoms, something like this. So we seem to be squeezing in this symmetrical triangle. I'm not sure which way we break. That's kind of what I'm watching for. I think ultimately the question is, do we get past the price resistance, which is up at about 365 to 370? Or what about support maybe around 280 to 285? Which one of these key areas, price levels, is taken out first? I think that's going to be key for Tesla. All right, and then let's take a look at Meta. Meta bouncing off of the 50-day. Didn't quite get to the 50-day, but got close. Came back up through the 20. I do like Meta. I think it's got a chance to run for 790. It's just had such a big run. I think maybe it consolidates for a while. And then maybe of the 7, the one that was most interesting, in my opinion, was Alphabet or Google. Google making a breakout and closing at a new high. I believe that this was a high that eclipsed the high back on February 4th. That's where we closed at 205.89. And on Friday, we closed at 206.09. Slight breakout. I'd like to see some confirmation and continuation this week. But Google has been making a big run to the upside. The AD line finally has taken off here over the last month and a half to 2 months. And so I think with this breakout, Google might be in the best position of all the Mag 7 stocks to really see some more growth ahead. So anyhow, that's what I had for this week. Again, awesome to see the Fed finally start talking about cutting rates. I think we're going to see a rate cut in September. I believe we're going to get 3 more to end the year. I think that the market also is pricing in at least 2, maybe 3 rate cuts the balance of the year. And if that's the case, I expect that we're going to see more relative strength ahead for those small caps. So definitely keep those stocks on your radar. All right, that is it for me. Again, have a great rest of your evening. And we'll be watching the market in the week ahead, trying to look for any other trends that develop, see if this strength in small caps continues or whether we get a little bit of a pullback first. But that's an area of the market I think that will be strong. Have a great week, everyone. Happy trading.